Welcome back to the Investing Markets and Money podcast, brought to you by the Armchair Trader. And today we're talking about the biotechnology sector, which is something that some investors find quite difficult to explore, given the level of technical know-how you need to invest in some of the companies in this area. And today we're joined by Ailsa Craig, who's one of the co-managers of the International Biotechnology Trust from Schroders, joining us in the studio. So welcome to the show, Ailsa.
Thank you for having me, Stuart.
I wanted to quickly start off with a quick explanation of your own trust. Can you just give us a summary of what it does and what sort of areas it targets?
Absolutely. And like you said, it's focused on biotech companies. It's 30 years old, over 30 years old, so founded in 1994. And it was originally founded to give UK shareholders access to the whole cross-spectrum of the biotech industry. So from venture all the way up to established companies. At the time, there weren't many established companies, but there are today. So basically, at the moment, we have the cross-spectrum of biotech companies with 6% in venture funds and the rest in quoted listed assets. The largest companies are the size of Glaxo and Astra over in the US. Most of our investments are in the US. So this is not all white coat biotechs, which I think people think that it is when you say biotech here. It's a closed-ended fund, so we can pay a dividend. We have a 4% dividend yield, paid out in 2 installments, 2%, 2%. And you mentioned I managed this with my colleague Marek, and we took over as co-lead in 2021. We've had 4 full fiscal years, and we've managed to outperform in each of those years. And importantly, in different market backdrops. So in down markets, up markets, and flat markets. And I can talk about how we do that later on, maybe. But certainly that's not something I can say we're going to do in the future. But we're very proud of the fact that we've done it in the past. The other advantage of a closed-ended fund, actually, is that we can gear. And I think that's massively helped performance. So tactically, we use that when there's been maybe an oversold period, like we saw last April. We geared up, and then we can take that off and put it back on accordingly.
Yes, it is something that some people always assume as a market that's confined to much smaller R&D-driven companies, and particularly during the pandemic, there were some names on the London market that were attracting a lot of interest, which were quite small, but the whole sector at that point suddenly became really, really trendy for obvious reasons. How's the sector changed since then? Because obviously, once the pandemic was over, things would have presumably returned to some sort of normality.
Absolutely, and this sector, we've seen this before, so it goes in and out of favour, and I think that's why it's important as a fund manager in biotech to recognise when we're having periods of overexcitement and the inverse, oversold. People get emotional about this sector. They buy blindly. They don't look at the valuations. And in 2021, we had that sort of perfect storm. We had new vaccines and new treatments for COVID at the time, lots of excitement around those names, and it drew the whole sector into really a kind of bubble type valuation period. So since then, we've had this relatively long bear market. Normally you get these cycles, but they're a bit shorter. But we have had a long one. And the way I describe this is we've had 3 punches. And the first one was your traditional valuations are too high correction. Then we had rising interest rates. And we haven't had this environment, if you remember, this is sort of 22, 23, for a long time. And rising interest rates hit companies that are long dated harder. It's not that these companies have debt. It's when you discount cash flows from the future at a higher rate, you're going to have a lower valuation. So that hit the sector. Then the third punch was politics. Everyone got excited that Trump had won, certainly in terms of industry. And that was primarily because the first term, biotech outperformed very well during his tenure. So people got excited about that. But then he appointed quite a controversial head of Health and Human Services, RFK, who in turn appointed quite controversial leaders of the various different departments within his sector. So at the FDA and NIH, etc. And then superimposed on top of that, we had Liberation Day, again, which affected broad equities market, but it also hit pharma and biotech. And we had a low in April last year. So what we saw is this sort of bear market that was a bit longer than normal. But since then, we have had a recovery. Liberation Day issues, so tariffs and drug pricing, feels very much behind us now. 16 pharma companies have done deals with the administration, and they've worked out how they can manage these two issues and put pen to paper. The FDA is still murmuring along as a bit of an issue. But what we have seen is a wave of M&A, which I'm sure we'll come on to, and that's really helped valuations correct to the upside.
And the FDA obviously really, really important for the biotech sector because the US market is so important, and they are the agency that approves new medicine, and that really drives valuations in this space.
Absolutely. It's a critical junction of getting a drug from clinic to patients. So they are the bottleneck, if you like. So any sort of changes on that front has caused disturbances from our side of the table. But at the moment, to be fair to them, number of drugs being approved each year is in line with what you'd expect. It's good. And they're being approved on time. So we can't see any tangible impact as yet. But we did lose the head of the FDA commissioner last week. So a new person will come in, and the industry will be watching that closely as to who that will be. Will it be an industry-friendly person, or will it be a more controversial appointment? Who knows? So we're keenly watching.
Yeah, no. Unpredictable as always in the US, isn't it? Can you tell us a little bit more about why innovation still matters in this space and how that drives companies?
Yes. So, I mean, our fund invests in the innovative side of the pharmaceutical market. And in order to get new drugs for diseases that maybe don't have any treatments, you need innovation. And innovation is something the West still do really well in this sector. New modalities and new drugs coming to address diseases that previously we couldn't treat or we did treat badly is vital. You know, we've got an aging population. They're growing as a proportion of population. And that's when you get sick. So as soon as you hit sort of 55, 60, heart disease, cancer, Alzheimer's, dementia, ratchet up. And it's those diseases, many of which are still untreatable or treated with very sort of old style drugs. So the answer to that would be innovative new drugs. And biotech is the sector that manages to innovate more successfully. So R&D in pharma has been cut back in recent decades. They're just not very good at it. Whereas biotech companies, nimble, young, budding out of universities, that's where the innovation is. And it's something the West is still very good at.
And speaking of innovation, obviously AI is a hot button issue with the investment community these days. And I see people asking about the impact of AI in this space as well. I mean, it doesn't naturally occur to you, but it's affecting so many other sectors. Are you seeing any benefits in the biotech space as well?
Yeah, and it's not a new thing. So machine learning and screening compounds and looking for targets, etc., has been going on for multiple years, decades. They've renamed it AI. I think when you think about the evolution of idea to drug on the market, AI plays a role at various different steps. And in summary, you would expect the duration it takes, it normally takes about 10 years, to be reduced by the efficiencies of AI to, say, 8 years. What you can't speed up or change is the actual clinical trial, which is a regulatory requirement to have a drug through a certain number of patients over a certain period of time. That's very difficult to see how AI can crunch that down in terms of time. What it can do is maybe screen out more efficiently drugs that might have shown a tox signal before they go into the clinic. It might be able to replace the use of some animal models. And then it definitely could find patients for a clinical trial more efficiently. Once the trial is done, it can crunch the data more efficiently, no doubt about that. And then once it's on the market, finding patients again, diagnosing patients. So whereas you'd have one pathologist looking at a breast cancer scan, you can then use AI to look at many different ones and find a tumor there, you know, by comparing to other different tumor types, etc. So diagnoses, I think, will be markedly improved, and already is actually using AI. So all of those factors, I think, will benefit this space overall.
And when we look at this space from the perspective of an investor, because obviously you guys are big investors in the space, what are the sort of ingredients for successfully investing in this market?
Yeah, I think we use lots of tools. I think our strategy at IBT is that we do a top-down analysis as well as bottom-up. Okay, we're not sat here saying we're going to invest in great science, buy and hold for 10 to 15 years. We do not do that. So we'll keep one eye on macro, watch where interest rates are going, watch the politics. These things are important. Move the fund if we feel like some areas are going out of favour into areas more in favour. And I touched on moving into profitable companies, say in 2021, which we did, and moving back into the earlier stage names when things are oversold. We can do that, and we do that. We also reduce our positions going into binary events. Many of your listeners would have seen or experienced themselves firsthand how you can lose your shirt in an individual company. And this is why I think it's important to have a fund, to diversify your portfolio, because you need to watch these names every day. So we reduce our positions into binary events, and then we would rather wait to see what the outcome was and buy it back. And if it's good data, we can buy it back. Even if it's more expensive, that's fine. We need to retain capital. And the other aspect that we need to do is watch the competitor space. What may have been the best asset in 2019 could get leapfrogged, and someone else could come with a better asset in 2021. And the beauty of our position is we can sell that and buy the next guy. Working in that company, it's much more exposed to a failure, or investing in one company and holding for 10 years, you're very exposed to competition. So we trade a lot. We actively manage the fund. So there's lots of things that we can do to kind of outperform the benchmark, which is our goal.
Where are you seeing the best risk-adjusted opportunities? And is that more towards the larger cap end of the universe?
So what we're talking about to shareholders at the moment is a theme called Biotech 2.0. And that is that a number of companies have moved through the pipeline successfully, all the clinical stages of development, and they are launching independently. The last few years, the proportion of drugs approved by the FDA from biotech companies was 70%, over 70%. 10, 15 years ago, the proportion was from pharma R&D. So biotech's actually taking these drugs to market now, and they are the innovators. They've really dominated that. And pharma has really stepped back, and they're really sticking to their knitting, which is to distribute and mass manufacturing and what they're good at. They're not necessarily good at innovation. So we're positioning ourselves in those names, so clinically de-risked names, or just launched, or launched, say, a year or so ago. So you're in the high growth launch phase of the drug, but it's not too risky. So in the middle of the pack, if you like, and that's where the majority of the fund is today.
Do you tend to favour companies that have got multiple horses on the go, or
completely depends on
the company?
Each individual case has its own arguments and merits. I think one-hit wonders, we call them. Those ones, they tend to be the earlier stage companies. If it's a unique asset and there's not much competition and it's meeting an unmet medical need, we'll definitely look at it. But it's quite unusual to have that kind of situation.
And are you seeing a lot of M&A activity in the trust portfolio at the moment?
So last year, the M&A was at peak, and our fund benefited massively from a huge number of deals. We've had a string of deals in recent months, actually, and these are out of this Biotech 2.0 bucket. And we've had 5 deals this year, so 15% of our NAV has been acquired this year. And last year we had 9 deals, and normally we have like 4 or 5. But because of the backdrop, which is during COVID, people couldn't meet up. And when you do a deal, you really need to eyeball people. So we think there was a bit of a dry period for M&A. And in the background, pharma has been facing a massive IP expiry, IP cliff. And this tends to go in waves. And the numbers are huge. They're expecting sort of $200 billion worth of sales to come off patent in the next handful of years. And that's a big number. And they obviously don't have this R&D productivity that they would like. So they're looking for those new revenues from acquiring biotech companies, which is why we saw a bolus of M&A last year for the wider sector and also our fund. And the things seem to be continuing this year. And as I said, like we've had 5 names already picked up, and on average, normally we get 4 a year.
And do you think Big Pharma's also responding to that trend you've already mentioned, where the biotech companies are actually taking their own products to market, so to speak, and getting them FDA approved?
I think biotech's marching on independently. They're saying, we don't need you guys, we can do this alone. But pharma, if they offer the right price, they'll sell. Ultimately, if it's a big disease market, it makes a lot of sense. But many of these disease areas are quite small if they're in a rare disease, so they can be a standalone company. But ultimately, pharma need commercial stage assets because the IP cliff is now around the corner. If it was 10 years' time, they could go and invest in early stage biotech, but they're shopping around these sort of commercial stage names because they've got problem tomorrow.
Yeah, no, interesting. And what are the key therapeutic areas that you think investors should be paying attention to over the next 3 to 5 years? I know, talking to some non-specialist investors in the market, some of the bigger guys are obsessed with longevity as an area of investment, but that might not reflect reality from your perspective. I just wanted to see what areas you think are going to do well.
Yeah, it's sort of longevity, isn't it? So I would tell investors that there has been a recent discovery. It's not been talked about much in the UK, if at all, which is that there's a new target. Well, it's not necessarily a new target. It's been a well-understood target in cancer that is often a mutation seen across numerous solid tumours, like 30 to 40% of all tumours, but it's particularly overexpressed in pancreatic cancer. Now, pancreatic cancer used to be what we called a graveyard disease, meaning nothing has worked. So for decades now, many biotech and pharma companies have discovered new mechanisms and drugs and compounds that work incredibly well in specific cancers, like Herceptin in the late 90s was discovered to dramatically improve overall survival in women with the particular type of breast cancer. Pancreatic cancer, nothing for decades, only chemo, and the prognosis is grim. However, a couple of months ago, we finally saw phase 3 safety and efficacy data in a targeted compound from Revolution Medicines for this specific mutation in pancreatic cancer, and it doubled overall survival in these patients. We haven't seen anything like that in this disease. And it could also be applicable to many other solid tumours. But to have this is game-changing. It's really a new discovery. It's very exciting. So I think it could be launched at the end of this year. Now, that would be unprecedented. Wow. The reason the turnaround is going to be so quick is because the new administration have announced these priority review vouchers where if a company has a game-changing new drug, like such as this, they will approve it instead of 12 months, 2 months. And it's going to be interesting to see whether that actually happens. So the company needs to file at the FDA, and then they're saying the clock starts 2 months later, they'll be able to launch. So to have that turnaround is spectacular. And it's no surprise. It should be. This is an incredibly huge achievement.
That sounds amazing. Yeah. I mean, what do you think, going on from that, what do you think would really surprise investors from the biotech space in the next 10 years? I mean, stuff that people may not be seeing and that will really
so when this
the market.
Sector, and we talked about this at the beginning, when this sector gets interesting and possibly sometimes overcrowded is when there is a new game-changing discovery. So we had this, with the human genome being sequenced back in early noughties. We had the discovery of immune oncology, so using, your own immune cells to target a cancer. Then we had it with COVID. We've had it with hepatitis C virus being cured. So that's when you get generalists kind of sniffing around, etc. So what you're asking is, what's the next one? We also saw it with obesity, right? GLP-1s. That's been another kind of game changer. I think what would be great is if we saw something that worked in Alzheimer's well. We've had some products approved in that area, but the efficacy isn't great, and there's some kind of quite nasty side effects that come alongside it. But having something that works in that disease, either stops progression, or if you can treat it even earlier, or potentially reverse, disease, that would be amazing. And there is a lot going on here. So something in the next 10 years working in that disease would be fantastic.
That'd be great, yeah. And finally, just to finish off, I mean, this is a market I actually find personally very interesting. But from your perspective, what's the most exciting part of biotech investing for you today?
Yeah, I think it's, treatments used to be little white tablets, right, 30, 40 years ago. And now the tools and technologies that can be used to treat a disease has expanded massively, from little white tablets to using antibodies to using cell therapy, so removing your cells, engineering them to find a tumor and putting them back in, radiopharmaceuticals. So all of these different platform technologies can be applicable across multiple different diseases. So that's what you're investing in with biotech, these sort of very clever, advanced science to address diseases that we didn't have treatments for before. So, for example, targeted oncology, we're just talking about in pancreatic cancer and doubling overall survival. The drugs that they're treating is chemo, really old school drugs from years ago. So you're investing in cutting edge science, and then you're benefiting patients overall, hopefully living longer.
Yeah. Would you say, from your perspective, would you say the pace of innovation has picked up?
It's compounded.
Yeah.
So as and when a new platform technology is discovered, it's compounding innovation, because you're addressing multiple diseases. So like with cell therapy, could we use anyone's cells to treat a sick patient rather than their own? It's quite hard work taking T cells out of a patient. You have to condition them. It makes them sick anyway. And their T cells are quite tired because they've been trying to fight a disease. So using a healthy person's T cells, that would be fantastic. So the innovation is incrementally growing and compounding over time.
Fantastic. Well, thank you very much for giving us some of your time today, Ailsa. Really appreciate it. I think it's a really fascinating sector for people to be investing in.
Thank you, Stuart.
The content of this podcast is for information and entertainment purposes only and does not constitute financial advice. The views and opinions expressed by guests or hosts are their own and do not necessarily reflect those of the armchair trader. Investments can go up and down in value, and you may not get back the amount you originally invested. Past performance is not a reliable indicator of future results. We do not provide any personal investment, tax, or legal advice. Always do your own research or seek independent professional advice before making any financial decisions. The Armchair Trader is a media company and is not authorized or regulated by the Financial Conduct Authority.